Hey traders, this is Blake Morrow with Traders Summit, and with me once again, I have Mr. Ted Oakley from Oxbow Advisors. He's the managing partner over there, and I'm so excited to have him because we haven't talked in a few months. Ted, welcome to the Trader Summit.
Thanks, Blake. Glad to be here.
Last time we spoke, and you'd said that the market's going to be in a bear market, but we're going to be in more of a range-bound environment for the next 5 to 7 years. And here we are, about five months from that conversation. I have to say you've had it spot on. Bearish bias. The market's been kind of range bound. How do you feel about the markets at this point?
Well, Blake, I think they have more to go. What I think is happening is we're in sort of an old-fashioned bear market. I've mentioned that before.
Yeah.
That probably lasts through the summer of next year. When I was talking about range bound, you sort of have to get through the bear market first, and then you're probably going to spend some time. What happens in these inflationary periods is you have to know sort of when to commit capital and when to take it off. We found that true in the 70s and early 80s, but I think you've got to get through the bear market first. And from our standpoint, we just don't see you can get a rally here. Yes, you could, 8 or 10%, but the bigger picture to us looks like you'll continue down into second quarter, third quarter next year.
Okay. And are there, I know this is asking a lot of especially portfolio managers, people like yourself that you're dealing with, high income individuals. What are some downside targets that you have in equities where you would, like, let's just talk S&P, where you would say, I'm ready to start committing capital on more of the bullish side? Or is there any level that you're actually looking at near term?
Well, Blake, we look at the individual companies and individual bonds. We don't do much in the way of indexes, but I will tell you on the index side, if you just look at where we think the numbers are going to fall, I'll use the S&P, for example, we'll be surprised if when it's all said and done, you don't come down to 3,000, 3,100 or something. I'm sure you could go past that, but I think that would normalize things. And that's what I think we're coming off this super bubble we have. I think you have to get at least that to sort of get back in a range.
All right. Well, that makes a lot of sense from a technical perspective, and I can see that obviously happening. Last time that we did speak, you thought one of the things that's going to weigh on the economy just in general is higher home prices, taxes, and inflationary pressures. Well, we've seen the inflationary pressures are obviously still front and center, not only in the Fed's mind ahead of the FOMC, which more than likely people are going to be watching this interview post FOMC. So I'm not going to ask you exactly what do you think the Fed's going to do and how should we react, because realistically people will be watching this after the fact. But let's talk a little bit about home prices, because we have seen, the Fed has engineered tighter fiscal policy or monetary policy at this point. And because of that, home prices look like they have significantly hit a high. So how do you feel about home prices here in the US and how that's going to affect the consumer, and how low can home prices go in your view?
Well, I felt like all along that they could go, they'd have a 20% correction probably when it was all said and done. I mean, one of the things you get into here is that it was in a bubble too, the housing market.
Yeah.
And if you look at, just 2 years ago or so, you had a 3% 30-year mortgage. This morning it was a 6.33, probably going to 7 after tomorrow, or particularly in the next month. So if you think about that, that really creates a lot of immobility for people to make a change, because if I've got a mortgage, I don't care what size it is, but if I'm at 2.5 or 3, now I have to go to 7. Well, I'm probably going to be selling that house anytime soon. And I think that's the biggest problem. The second problem is if you look at the numbers that just came out today, National Association of Home Builders, all of those sentiment numbers on everything they're thinking about is going down, hit a new low. Now, you did have starts tick up a little bit, but permits went down. That's not unusual because builders will throw it up anyway. They'll keep on going a lot of times, so they just hit the wall. And so we see that a lot, particularly with independent builders. They just, they just have to throw it up to get a draw and keep things going. Now, whether that keeps, how it comes out, we don't know. But I will say this: almost every market, we're probably in 40 states, maybe. Almost every market we talk to, they tell us that it's softer than it was. And so we'll just have to wait and see. But I suspect from the top, it would be at least a 20% correction generally. Depends on where you are, that obviously, position and location, but I would expect something along that line.
Okay, when you're living in a post-COVID world where obviously the dynamics, the workplace dynamics have shifted, and people are seeking out that extra bedroom, that extra office, that office to work at home from, maybe even if it's 2 or 3 days a week instead of being back in the office full time. Do you think that's going to shift or weigh on like the inventory picture, where inventories continue to stay? Because to your point, inventories might stay tight because you still have people searching for that work at home environment, yet you have other people that don't want to necessarily sell their home because they do have a mortgage that's at 2.5% or maybe even sub 3%, whatever it is. How do you think that's going to play out? And do you think that is going to at least put in some sort of low or a bid in the housing market for some time?
Well, Blake, the housing market was much like the stock market and all these other assets for that matter. They were overpriced as well. And people were paying, ridiculous prices, and still are to a certain degree on a lot of things. And I think what happens is when the entire economy starts to shrink down and people just don't have the kind of money they had before, then all of a sudden you'll see how, the two things that really lag in the GDP area are housing and employment. Yeah. Both of those things, they come in later on because real estate is a slow moving animal. And what happens is when it gets in trouble in the end, it's not like stocks. They don't crash it or something like that. It just goes really, really dull. And what I'm noticing now on Redfin, Zillow, those kinds of things, that their listings are not going up so much. Actually, they've come down some, but they're not moving a lot of real estate. You're not seeing a lot of movement and selling. So it's probably just started, but I'll tell you, if you get a 7% mortgage, it will impact it for sure then.
Oh, from an affordability standpoint, you bet. Yeah. Speaking of affordability, let's shift gears and talk a little bit about stocks. So, going back to the stock market, valuations, are they I talked about or asked you about technical levels that you might be looking at, but how do you see like the valuation from a valuation standpoint? How are you viewing the stock market as a whole?
Well, we look at about 200 companies that we would like to own in our stock strategy. Yeah. And I have to tell you that most of them are still above the spot where we would want to take new positions. Now, we have positions, of course, but I will tell you in our stock portfolio, we're only about 48% invested, about 52% liquid. But the reason being is because we've sold things, there's nothing there for us to buy. And they got really expensive in the last quarter of last year, and there was nothing for us to buy when we ran the screens. And we do, even this year, if we adjust most of these companies for what we think they'll earn, going forward over the next 12 months, they're not in a place right now where we would say they're just screaming buys. There's a few things you can pick off, but really, right now, I think what is missing is more than anything is that most of these companies, I mean, FedEx was just a shot over the bow. You're going to see a lot of them like that, where, their numbers are lower than the street is expecting. And so when you work that in over the next 2 quarters or 3 quarters, then you'll get the market to a spot where it says, okay, we're fairly valued or undervalued potentially. But we don't think that's right here.
So you currently, the way Oxbow Advisors works, and correct me if I'm wrong, you work with very high net worth individuals, and you just help tailor their portfolios to the current environment. Is that correct?
Well, you know, Blake, the way we built the company over really since 1984 was we work with a lot of people that have sold companies all across the country. That's sort of a trademark of ours. And so most of those people, and the same with inherited wealth, when you have a finite amount of money, it can be a lot of money, but it is all you have.
Yeah.
And so, you know, you have to get in a position where when you go through these periods like this, you have to create some preservation. You don't have to be 100% cash, but you've got to put yourself in position so you can survive the downfall and get through to the other side. And that's where you make a lot of money. You manage the risk in these down markets. That's the most important thing.
And how are you helping your clients manage risk? What products and what parts of the market are you specifically targeting at this point?
Well, I'll give you an example. We have in every strategy, and I know people are going to think this is high, but every strategy we have right now, we're at least 45 to 50% liquid. Now, we're not just sitting there in a money market, don't get me wrong, but we own a lot. I mean, millions and millions of dollars and hundreds of millions of dollars of the U.S. Treasury floating rate security, okay? And one of the reasons we own some 1 year and 2 year and 3 year, and we even own 5% of the 20-year, but it's a small piece. And what we do on the majority of those funds is we keep them less than 2 years, but particularly on the largest amount, we keep in the floating rate U.S. Treasury. Now, I'll tell you, even 20 months ago, they were yielding about 10 basis points.
Yeah.
And today they're yielding, I just got the quote today, of 333.
Wow.
And it's a floating rate, you know, it resets every 90 days. And so we can put money in there on a holding point till we figure out where this Fed's going.
Yeah.
And then we'll move on from there. We own a lot of income items in two of the other strategies too, but I think you have to have some cash flow, and that's where we're trying to get to this year.
That makes a ton of sense. You know, and this is something that we didn't talk previously before I hit the record button, but I want to ask you your thoughts really quick on inflation. You know, there's a big debate right now on inflation is going to stay persistently high and it's going to continue higher, you know, going into this fall, or we have actually reached peak inflation. Do you have any thoughts on the inflation environment and what we can expect as consumers and investors? Let's just call it maybe over the next few months.
Well, you know, I was hoping, Blake, 18 months ago or so, I was hoping they would really be able to get a handle on it, and they never did. But if you look at inflation, you look at the inputs that are going into inflation right now, which are going to be energy, employment, and cheap labor, which we don't have much of anymore if you look at China.
Yeah.
And you look at the material costs going in, we're in a position right now to where I think people, they're so hoping that we go back to these 2% inflation, 2% interest rate. It doesn't look like we're headed there to us. We would have wanted to at one time, and maybe they bust the economy and you bring it back to that level. But right now, it looks like that the way you see the inputs over the next 5 years or so, particularly energy, you know, we're probably going to be stuck at least with 4 or 5% inflation. It doesn't have to be 9. But even 4 or 5% will create a different atmosphere for stock picking, bond picking, all those sorts of things. I don't think people are really ready for that. And Wall Street, at least the majority of what we see is that, hey, we'll get past this rough patch. We'll be right back at 2 or 3%. I don't think that'll happen. And it may happen somewhere eventually down the road, but if it happens, it's because we really break this economy hard. But that we see, you don't have to stay up at 9% or something. Like, we don't think we're in the 70s, but we certainly think that we're a lot like the early 70s, where they would swing it up, swing it down, swing it up, swing it down. They couldn't get a handle on it. And I could see 4 or 5%. Maybe we don't stay there, but it sure looks like it to us.
All right. Well, I would tell you from an investor's point of view, somebody like myself that's been in the markets for quarter century, a little bit more, I look at people like yourself that have really gone through the ups and downs and through the cycles, and that would be from an investing point of view and from a portfolio management point of view. That is something that I would be looking for to what Oxbow Advisors does. So could you tell us a little bit about how we follow your work and what you guys do over at Oxbow Advisors?
Well, the best way, Blake, is just to go to the website, oxbowadvisors.com. We have all the books we've written, all of the quarterly reports we put out. We do quite a few videos that we go directly to clientele, but we post those, and we have a lot of interviews and things we do. We stayed generally in the same mantra for the last 12 to 15 months. I think people gave us a hard time last year in the third quarter and fourth quarter a little bit, but our point is that hey, it's coming and you better get ready for winter, and we saw that being that way. But that's the best way to follow us. We're on Oxbow's on Twitter, at Oxbow Advisors. You'll see us there, if you go to the website, all you have to do is request to add to the email list, and you'll get almost everything that we print.
All right.
Be happy to send it to your people.
That is that's the best. That is the best thing that we could ask for, and I love it. Ted, I want to say it's always a pleasure catching up with you. And if you like the content that you're seeing here, make sure you give Ted a thumbs up. Subscribe to the channel so you don't miss any of this exclusive content at Trader Summit. And I want to thank you for spending your time, your very valuable time with us over here at the Trader Summit community.
Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.